Dozens of Chinese EV companies are crashing and burning, leaving a trail of broken dreams and bewildered investors. Billions pumped in, bankruptcies out of the wazoo. What's the deal? Is the electric car revolution stalling before it even leaves the garage? Let's take a closer look at this EV meltdown, exposing the hidden reasons these companies are going belly up. Tune into this Electric Vehicle Exposed because the truth about the Chinese EV market might surprise you, so subscribe to the channel first. A few years ago, we heard reports about hundreds of EV makers in China, each boasting new technologies and ambitions to dominate the global market. However, today's reality paints a much different picture. It's become clear that there simply isn't enough space for all of them. The market is oversaturated, capital is scarce, and the ongoing price war has only intensified the challenges. So, let's explore in detail the real reasons Chinese EV makers go bankrupt. In China, there's this fascinating phenomenon popping up everywhere called EV graveyards. Every major city has one of these spots, piled with hundreds, if not thousands, of abandoned electric vehicles. What's really puzzling is that all these cars have license plates, indicating they were once bought and registered. So how did they end up like this? The story goes back about 2 decades when the Chinese government decided to pour billions into what they called new energy vehicles. Think hybrids, plug-in hybrids, EVs, and hydrogen fuel cell vehicles. Fast forward to the end of the first decade of the 21st century, and it became clear that EVs were the way to catch up with Western car makers. So, the government ramped up funding for startup companies, leading to a whopping 500 EV makers in the country. But as you can imagine, so many companies in the mix couldn't last forever, especially when authorities started tightening incentives. One key condition for these companies to get subsidies was to sell vehicles in certain volumes. However, meeting those targets was no walk in the park for many small startups with limited capital. That's where things get shady. Many of these startups were suspected of selling EVs just to cash in on incentives, while car-sharing companies that bought them may not have had any real plans to use them regularly. Some people argue it was all a ploy to milk subsidies from the government, while others say it's just a natural process where most startups either go bust or get swallowed up by bigger players. Moreover, about 90% of the EV companies that once dotted the Chinese landscape have all but vanished into thin air. When China set its sights on becoming a global leader in EV technology, it opened the floodgates for startup companies. By 2018, the number of EV makers had skyrocketed to 500. But even China's mammoth economy couldn't sustain all of them. Sure, many of these companies managed to snag some fancy tech and set up production facilities. But when push came to shove, and it was time to start churning out vehicles in large numbers, they hit a brick wall: money. And just when they thought things couldn't get worse, along came COVID-19, followed by an economic crisis. The harsh reality was that there simply wasn't enough room at the EV table for everyone. Reports from last year showed a significant drop in the number of EV makers, officially down to under 100. But experts reckon the number of those still in the game is much smaller. And the sad truth is, many more are likely to bite the dust in the near future. See, to keep the lights on, you need cash flow. And to get cash flow, you need to sell cars. But here's the rub. Most of these companies never managed to hit decent sales numbers. Many were stuck selling a measly 500 units every quarter, hardly enough to attract new investors. Another good reason for the EV market's fall is that 5 Chinese companies have thrown in the towel in just the past few months, some of which were once seen as promising contenders. The problem is a simple math equation: too many players, not enough pie. Now, before I elaborate further on this, make sure that you have subscribed to our channel and liked the video, as it's totally free. Here's the deal. If you take a peek at the Chinese EV market, you'll see that the top 10 manufacturers gobble up a whopping 8% of total sales. That leaves a measly 20% for the rest of the bunch to fight over. And let's be real, that's not a big enough slice to go around. Research suggests that about 1/3 of the EV makers still sell more than 2,000 vehicles a year. But for the majority, it's a different story. They're struggling to keep their heads above water, and many are teetering on the edge of bankruptcy. The recent casualties include names once on the fast track to success. Take Line, for example, once hailed as potential Tesla rival. Then there's Neutron, Evergrande New Energy Auto, and WM, all victims of cutthroat competition and brutal price wars. Evergrande, in particular, stands out. The company couldn't drum up decent sales numbers despite pouring billions into its EV ventures. In fact, they were bleeding a staggering $17 million for every EV they managed to sell. WM was sitting pretty with a hefty $5.3 billion in capital, but even that war chest couldn't save them from the harsh realities of the market. Now, they're in the midst of a massive restructuring, desperately seeking new investors to keep the lights on. But let's face it, things aren't looking too rosy. So yeah, the EV graveyard is getting crowded, EV makers are going bankrupt, and it's a reminder that survival is anything but guaranteed in the cutthroat world of electric vehicles. Do you think the crashed Chinese EV market will be able to thrive once again anytime soon? Share your thoughts on this with us. Do you mind subscribing to the channel and liking the video? See you in the next video.